So, I mean, Joe can shower us with some data, but we've been following SPACs. If I think they've been around for a long time. They did peak up at like 7-8 billion. This year might be 50 billion. Relative to how you're raising private equity in the regular way markets, which we tend to do. But we wanted to sort of shine a light, get some people in to join us that have, that are leaders in the area and who can sort of walk us through what their lessons have been. And then otherwise, a few others that are looking at creating some SPACs. So this also might be a subject that we talk about a lot. Joe, do you want to tee this one up?
Yeah, sure. And Scott, welcome. I see we got Scott Gordon here. We thought this would be a really interesting kind of conversation to dig into. Obviously SPACs have been around since the 90s, but they kind of basically just disappeared after the growth of the traditional IPO market. And so what we're seeing now is this huge resurgence, right, over the last few years. And 2020 has really become this, year of the SPAC. And so, even in some months of 2020, SPACs are outpacing traditional IPOs. And I think to date, issuance is around 33 billion and on track for, I think, around 50 billion or so in 2020. So it's like a tenfold increase over the past four years or so. So we thought it'd be, a good idea to kind of dig a bit deeper, do a dedicated deep dive to this asset class. We're lucky to have Scott Gordon joining, who's going to be kind of leading this discussion. He's the CEO and founding partner of Silver Spike Capital, which is an alternative asset management platform focused on the cannabis space. Scott's got a really impressive background, having been, working across various organizations on Wall Street and within the emerging market landscape for the past 35 years. And so now I think he's really highlighted and focused on this new emerging market asset class, which is cannabis. And I think obviously Scott's got tremendous experience even in that space, having left, being the president of a multi-billion-dollar family office to, really go and found a health and wellness brand in California focused on the cannabis market, Papa and Barclay. So Scott, would love for you to kind of maybe just give a quick overview and then really start to just dig into what you guys are doing. And just to kind of, as one quick, question out the gate, why was a SPAC, you guys did a $250 million NASDAQ listed SPAC as one of the first things you did in August 2019 at Silver Spike, right? Why was that the first thing you guys did?
Yeah, thanks, Joe. We started the firm in the spring of last year, and really what we've been trying to create at Silver Spike is something differentiated in the cannabis investment industry, which is to have a platform approach that really kind of plays across all aspects of the capital structure of the sector. Traditionally in the very short life of what has been the cannabis investment realm, you've had a handful of players largely sort of dedicated to kind of one thin slice of the cap structure. So you've had some venture funds. There was virtually no dedicated like traditional private equity later stage capital. There have been a small handful of hedge funds that have played in the space. You've had some pockets of lending activity among REITs and some dedicated credit providers. Our vision and ambition was to sort of bring all of that together under one roof and have strategies that really kind of span all of those different parts of the capital structure, including companies that are ready for prime time and about to go public. And so that's where kind of the SPAC fit in. We felt, if we have a pillar that's a credit strategy, another pillar that is sort of a private equity venture strategy, another pillar that is a public trading sort of hedge fund vehicle, we felt that sort of having a pool of capital that we could use for a single or a single acquisition or a set of targets would be complementary and synergistic, kind of the broader platform that we're hoping to build at Silver Spike. So we went straight for the SPAC, largely because it was probably the most efficient means by which to raise capital quickly. Those other strategies, which are, sort of more kind of the root of, a traditional sort of LP raise, as you guys well know, takes a lot of time. It's a big lift. the SPAC process is extremely efficient in terms of getting out into the capital market and raising a big chunk of money in a relatively short period of time. So we chose to lead with that. I had been kind of priming the pump with CS, helping them kind of get up the curve on the cannabis industry and its many nuances. So we had a good relationship with them that was already established. They, as you probably know, are sort of among the market leaders in the SPAC space, and it just kind of all coalesced and worked out well from a timing perspective.
Okay, great. And why do you feel, Scott, that the SPAC vehicle is aligned and I guess with a cannabis focused business? Are there specific reasons why cannabis and SPACs kind of worked well together?
Yeah, I mean, I think there's just the generic argument that SPACs work well for any industry and any potential target.
Category 4 now.
I think in
Sorry, that was me, Scott. I was trying to mute someone else. Give me a second. There you go.
All right, can you guys hear me?
Yep, that was me. Sorry.
Okay, I don't know when, Mark, you muted me.
About 5 seconds ago. Sorry about that.
Okay, so no problem. So yeah, I was saying that I think cannabis companies are probably even more or better beneficiaries to the SPAC vehicle perhaps than more established industries. I think just given the relatively nascent stage of many of these companies, they've been extremely focused on just getting their businesses set up and really kind of operating them. And many of the operators in the space don't have either the capacity or the experience or sort of the financial sophistication or savvy to kind of figure out an IPO path on their own. So the SPAC is a means by which to access the public markets and get a partner who is accretive to the story. We felt was sort of a very compelling value proposition. I think we did our SPAC before kind of the SPAC mania took hold. I think it's been, it was interesting when we did the SPAC. I remember sitting on a panel about a year ago and getting completely berated by one of the fellow panel members who was just, completely denigrating SPACs as a flaky capital market tool. And, lo and behold, here we are. And it's it's just gone, it's gone crazy. So, I mean, I think at this stage, it's hard to really question kind of the legitimacy of the SPAC vehicle. They've, shown themselves to be a very relevant tool, an alternative to an IPO. And I think, all of the reasons that rings true for any target who's considering a public market exit is, particularly true for companies in the cannabis realm.
Got it. But obviously, a lot of companies up in Canada in the cannabis space, chose to kind of do SPACs in that market. Why did you guys choose to kind of limit yourselves and, list on the NASDAQ? Obviously when I say limit yourselves to non-plant touching businesses via NASDAQ, right? Relative to what's going on in Canada.
Yeah, no, for sure. And it was definitely, it is a limitation because, the plant touching part of the market is big and bigger than the sort of non-plant touching part. However, we felt that there were sufficient opportunities out there, within the realm of things that are not plant touching, or as we like to say, federally legal, because plant touching is a bit of a misnomer. Our criteria is that, the target company or set of targets has to be compliant within the federal jurisdiction with which it operates. So a Canadian company would be fine, and that's plant touching. So it's really only plant touching in jurisdictions like the U.S. where that's not yet federally legal. But part of our mission at Silver Spike is to really kind of think about how this market will evolve and become institutionalized. And, we feel that while the Canadian market, I think, has been great in terms of, paving the pathway for capital market acceptance of cannabis companies, it does have its limitations with respect to the depth and the quality and certainly sort of the institutional participation of investors in that marketplace. And, we're trying to kind of elevate the conversation and the market toward a more institutional framework. So we felt a listing in the US, on a major exchange with a major investment bank behind us and underwriting our transaction would sort of, go a long way towards sort of establishing that type of investor base for the deals that we were looking at, and felt that the trade-off of foregoing, companies that are, for instance, plant touching the US was a worthwhile one.
Got it. And I recognize that you guys are, doing a potential New York Stock Exchange listing of your holdco, asset management business. Is that a SPAC? How's that set up? How are you guys positioning that? And I'd also love for you to kind of, go ahead, answer that question first, and I'll kind of follow. No, go for it.
No, that's not a SPAC. We're contemplating a permanent capital raise to raise capital in the public market in the US to give us balance sheet strength that will basically complement all of the other asset management activity that we have on the platform. And it was interesting. A lot of the reason that we're sort of moving toward that initiative was informed by our experience with our SPAC. In that we've looked at a tremendous amount of companies. I couldn't tell you how many, and most of which are were not sort of good for the SPAC for a number of reasons, but virtually all of which were in need of capital and fit our sort of eligibility criteria. So we thought, wow, if we had a pool of capital that we could dedicate towards not having necessarily to make a major acquisition, but just to provide, some form of capital, whether it's a loan facility or whether it's a Series B equity round. And so, it was really through that experience that we approached both the New York and the NASDAQ and sort of worked extensively with them to come up with a structure that would allow us to raise capital, permanent capital, onto the balance sheet of our holding company, and to do that in a framework that would be consistent with the listing requirements for a US listing. And so it's a bit, we kind of refer to it as the KKR model, where, if you look at KKR relative to some of the other big publicly traded asset management firms, they have a very big balance sheet that they deploy. Last I checked, I think it was in excess of $20 billion. So as an investor in KKR shares, you're actually having two income streams. You get the return of the balance sheet capital that they're deploying, and you get, your proportionate ownership stake in all of the third-party asset management fees that they're generating. And our hope and our intention is to build something similar, where we have balance sheet capital that we're deploying, hopefully at a very attractive return, and we're using that capital to co-invest and complement all of the other investing activity that we're pursuing on the platform. So, an investor in our holding company equity will have, like in the case of KKR, those two income streams. So it's not a SPAC, it's not a closed-end investment fund that's trading publicly. It's really sort of an asset management company with permanent capital on the balance sheet, which we think is a very compelling model.
Okay, and so sort of you can continue to do SPACs under that asset management company, and I guess investors in that vehicle are now kind of like investing into a GP stake, right? Which they're now getting.
Exactly. So, so all of the big asset managers, well, many of them have SPACs that they do. And so, if you're an investor in Oaktree, who's doing SPACs now, when they're the sponsor, and, whatever the sponsor economics that they derive from a successful SPAC transaction, they're sharing with their investors. It will be the same for us going forward. Shareholders of Silver Spike will participate in everything that we're doing, including our intention to, continue doing SPACs among a variety of activities that we're pursuing on the platform.
So could you walk us through the various parties that are involved in a SPAC transaction and, what their alignment of interest is across, the companies that use the SPACs to go public, the promoters, the investors, just kind of help us understand what that landscape looks like.
Yeah, I'll do my best. I'm hardly the SPAC expert, but having now been in it for over a year, we've learned a lot, and I think understand the landscape pretty well. So obviously you've got folks like us that are the sponsor. We put up at-risk capital to get the deal done and launched, and in return for that, we have sponsor shares, which is sort of analogous to the carried interest or the promote that you would find in a traditional GPLP structure, whether it's private equity or hedge fund. That equates to sort of 20%, except in the SPAC sponsor, it's 20% grossed up. The SPAC initially, when it's launched, the IPO typically gets sold primarily to hedge funds, and those hedge funds tend to be fixed income ARB players. They like the SPAC structure because of the redemption feature. So, it essentially gives them free optionality. The way the SPAC equity works is that, you buy the IPO, you have a common and a warrant. We did ours with a half warrant. The market is sort of now going more towards like a third warrant. And then at some point, not long into the life of the SPAC, the unit separates and the warrants trade separately from the common, and you don't need to keep them attached. But at the end of the SPAC life, and after a deal gets announced and before a deal gets consummated, those investors who own the SPAC shares have an opportunity to redeem at what's called the trust price, which is the proceeds of the IPO get invested into a trust account, accrue interest at a very modest rate. And so once the deal's announced, if the market or an investor doesn't like your deal, they can just redeem. So there's really an embedded put. On the other side, there's all of the optionality that, the deal gets announced, the market likes it, the shares trade up. And so, you can sell out at a much higher price to somebody then who becomes the fundamental buyer of the back-ended de-SPAC story. So that's kind of a bit, the dynamic. I think the alignment between the target and the sponsor is such that, both are only going to make money and succeed if the deal is priced in a disciplined manner and the market accepts it and likes it. The sponsor has a certain lockup that will ensure that the sponsor is only making money over an extended period of time, and if the stock does well. And so there's absolute alignment between the sponsor and the target company. And then I think the relationship, between the target and the sponsor after the de-SPAC can be very variable. There are, I think, several different types of sort of relationships that kind of continue on after the de-SPAC transaction between the sponsor and the target. One where the sponsor can be very involved, even at an operational level or, short of that at a strategic level. And then there are other deals where, basically it's more sort of transactional and the ongoing relationship between the sponsor and the operating company after the de-SPAC is less relevant. So it really depends. There are a lot of different models out there. The other kind of, the other player in the mix is the underwriter. And there I would say sort of the dynamic is twofold. One is placing the shares up front when you raise the SPAC IPO. And again, I think that's largely an exercise that's mainly concentrated into the hedge fund community. And then I would say, perhaps the more important and trickier role that your investment advisor or investment bank or capital market advisor plays is on the de-SPAC on the back end, where really you're trying to successfully kind of transfer the ownership from the hedge fund holders to the more fundamental buyers of what is the NewCo story. And so I think that, we felt it was really important to work with, somebody at the caliber of Credit Suisse who could help to transition, particularly in the realm of cannabis where, it's poorly understood and there's, a lot of kind of concerns and ambiguities from a regulatory and a legal perspective. So yeah, that's, there are a lot of, I'm sure I'm missing many things, but, that's kind of the sort of the basic, set of players and how they play together.
That's helpful. So for an investor standpoint, right, what are the kind of key considerations we should be thinking about? First off, when it comes to profitability of investing into a SPAC, I've heard, some people have done incredibly well. So what is the profitability of these underlying, SPACs? And then, what makes one SPAC more attractive than another? And then what are the key risks that you're kind of taking by investing in a SPAC?
Yeah, well, I think it depends, when you're investing in it. And so, again, if you're investing in the SPAC shares, when they're issued, the risk is pretty low. The risk is that a deal gets announced, the deal doesn't trade well, and you redeem at the trust price, and you end up making 1% for your troubles, right? The upside is that the deal gets announced, the stock goes from 10 to 13, and you made a 30% return, really for something where you took little or no risk. So, the profitability for the sponsor then becomes a function of, those are the investors, right? And then once you've announced the de-SPAC, then it's just sort of like an IPO. It's really, then the new investors are coming in and the risk they're taking is the performance of the underlying business in the new co, right? Is this a good company? Is it well positioned? Do I like it at $11 a share, valued at, 600 million of enterprise value? And where is this thing going? The risk and the profitability to the sponsor is totally dependent on the post de-SPAC performance of the new co equity. So typically there are lockup provisions that tie the sponsor in for at least 6 months and usually a year. And if it's a good story and the stock trades well, the SPAC sponsor can sell his shares over time and do quite well. If it's a story where, the de-SPAC gets done, but then, there's disappointment in terms of the operating results of the new co, and the stock post the de-SPAC goes from 10 to 4, the sponsor's not going to make that much money, if any. So, I think it really completely depends on, the performance, having sort of a disciplined valuation that you're bringing to the market for your target company, ensuring that you've got an appropriate investor base that's behind that story. And then, really hoping that the company executes on its plan.
Okay. So obviously you've been around, Wall Street for a little while, Scott. Do you think this is, another fad? Do you think this is sticking around? Do you think, just looking at like kind of the issuance, we had a chart that was kind of just showing, it was like, I think that the last time we were anywhere near this kind of level in terms of issuance in the SPAC market was like 2007, which immediately kind of gives me the heebie-jeebies because I don't know, I know there's probably no correlation, but immediately my brain goes to, right? Because when you look now, most recently, the chart is just, hockey sticked, right? So where's this going?
Who knows? We talk a lot about it at the firm. And, sometimes I've personally wondered, whether this is something similar and analogous to the explosion of hedge funds, right? If you go back, Joe, before your time, but, in the early 90s, you had a handful of hedge funds that sort of dominated, the hedge fund landscape. There was Tudor and Moore and Soros. And, there were 20 hedge funds that comprised, 80 or 90% of the hedge fund universe at the time, with 20 billion under management. I'm sort of making stuff up. I've since long forgotten those numbers. And then suddenly, there was this massive proliferation of everybody starting a hedge fund. And, I was thinking back in 1996, well, this isn't going to end well. Like, how much alpha is there to take out of the market? Like, can you really have 300 hedge funds managing 100 billion? And, you know, lo and behold, here we are 25 years later, and you've got thousands of hedge funds managing, I don't know what the number is, in excess of $1 trillion. And, you know, it really sort of disrupted the, you know, traditional asset management world as we knew it 30 years ago, right? Which, you know, tended to be mutual funds and pension funds and insurance companies and a few scrappy hedge funds. And I think that SPACs are perhaps analogous in that they're disrupting in a different way a capital market process, which hasn't worked particularly well, which is, you know, the IPO process. And that's also being disrupted through other, you know, forms like direct listing, and we'll see where that goes. And I think much like with hedge funds 30 years ago, you know, you'll have some good ones and you'll have some bad ones, and you'll have periods of time when, you know, there are people out there that are doing SPACs that probably shouldn't have raised one. And you'll, you know, perhaps have periods of time, and maybe we're on the brink of one where you've got, you know, an excess pool of SPAC capital that needs to be deployed. You know, a sort of a supply demand imbalance, if you will. And, you know, some SPACs don't get done and some people lose money, or some bad SPACs get done. And, you know, the market sort of comes to some sort of an equilibrium. I think that's really the dynamic. I think SPACs are here to stay. I think they are very much a legitimate alternative to the IPO process. I think, you know, they'll continue to get tweaked in terms of their structure. And I think, you know, you'll see some huge successes and some horrible failures along the way. And the market will weed itself out. But so I kind of think, you know, it is in this like hot zone right now. But I also don't think it's a fad that's going away anytime soon.
Okay. We just had a question come in from Duncan Riefler. So if I'm a private company, how would I look at an acquisition approach from a SPAC relative to an approach, you know, from traditional PE?
Yeah, well, I think the, you know, if it's traditional PE, I think the benefit of the SPAC, and targets tend to look at it, you know, more relative to an IPO path and less relative to sort of a PE approach. And, you know, I think the SPAC, one of the big advantages that a company owner derives from a SPAC transaction that they wouldn't get either in a typical PE deal or probably even an IPO for that matter, is the flexibility around the use of proceeds. So, you know, there's a lot more, usually there's a lot more capital that can go out on secondary to company owners through a SPAC deal than you would get in an IPO or certainly a private equity round. I think that, you know, relative to the IPO process, you know, one of the other sort of features that target companies like is the relative certainty of a SPAC deal. You sort of negotiate and come to a value as part of a collective price discovery process between, you know, the SPAC, the target, and the bank advisors that are involved on either side. And you agree to it, you sort of test it in the market, and you launch. Whereas, you know, there's always an amount of uncertainty in an IPO up until the day the deal is done. There's uncertainty with respect to valuation, deal size, and then, you know, the world's falling apart on the day that you're about to launch, or for, you know, a week or a month, and then the thing gets shelved for 6 or 12 months. So, you know, I would say that, you know, certainly the conversations that we've had with targets, generally it always comes back to the features that they find appealing in the SPAC deal generally come back to both the flexibility in terms of use of proceeds, as well as the relative certainty that the SPAC process brings compared to an IPO process. We've had very little in our own experience of discussions with targets where the competition to us was a PE deal. So I'm you know, harder for me to comment on that. And that might be just a function of just the lack of traditional PE money that's available to the types of companies that we're looking at, which are, you know, in the cannabis realm that really don't have access to that pool.
Okay. We just had, by the way, we had another question. And if people have questions, you can either just jump in or drop them into the chat. I'm happy either way to keep it conversational. But Lubium Gerashmenko said, is there any empirical evidence that SPAC transactions crystallize better valuations than private PE transactions due to the implicit elimination of the discount for the lack of marketability argument?
I don't know. That's a good question. I'm not sure.
Okay.
I'm sure there's anecdotal evidence. Empirical, I don't know. I think, you know, there's been obviously such a massive wave of SPAC activity that's, you know, just resetting the bar here. And so I'm sure there is empirical evidence as it relates to SPACs of old. But it's really a new world today, and I don't know that there's been enough data, hard data, that's been accumulated over the course of like the last 6 to 12 months to really sort of provide any sort of empirical or substantive view on that. But interesting question.
Okay. Christophe Charlier, are you on the line? I see you there, but are you
Yeah,
here?
I'm here.
Cool. Would you mind giving, just to kind of quickly just bring in a different perspective? Mark mentioned to me that you guys were looking at doing a SPAC a little bit more niche, maybe focused on Africa. Would love to kind of just hear what you guys are thinking.
Yeah, just by way of background, I was for 3 years chairman of the board of Renaissance Capital, a investment bank focused on emerging and frontier markets with a major specialty for Africa, very active in the African capital markets and bringing African companies to the London and New York Stock Exchange. And, the idea of launching a SPAC for Africa, was first presented to me a couple of years ago. And at the time, it just didn't seem like the market was right for SPACs. It wasn't as booming as it is now. And I think the opportunities in Africa were not quite as developed. Looking back over the last few weeks and months and seeing what's happening in the SPAC market, looking at what's happening in African capital markets with quite a few interesting companies that were in the pipeline to do IPOs, which have been delayed because of the current situation, had me rethink my thesis from a few years ago and come back to the idea that this may be the right time to bring one of the well-developed, attractive, strategic African companies to the New York Stock Exchange through a SPAC structure rather than a traditional IPO. So I've been spending some time in the last couple of weeks talking with investment bankers and private equity firms and major Russian African entrepreneurs, business people, and bankers to basically see if I can find a good list of targets that I could be looking at, and speaking to investment banks to see if investors in the US, because when you speak about SPACs, you mainly speak about US investors, whether they would be interested in a SPAC focused on an African company.
Christophe, he might be joining, but do you know my friend Ivan Tavern?
I do.
Okay. Because he might have some perspective to share on that.
Well, to be honest with you, looking at, Ivan's history in trying to launch a SPAC a little while ago and having a hard time raising financing, quite honestly, that was what at the time kind of cooled me off on the idea. And also, frankly, the fact that he's been able to do it over the course of the summer, all by Zoom, gave me, a bit more courage in launching this myself. So, it'd be great to hear Ivan's viewpoint, because he has been kind of, an inspiration for me in my journey.
To that point, Scott, I'm curious, 2 questions just kind of jumped out off of what Christophe was just saying. Was it difficult to raise the sponsor equity in SPAC number 1? And how many companies did you guys see through that process?
No, raising the sponsor equity, we were able to get done pretty quickly. Much of that was provided by ourselves, the partners and the insiders at Silver Spike, and we kind of filled it out with friends and family. And we were able to manage that pretty quickly and pretty efficiently. In terms of number of companies that we've seen, oh boy, north of 100, easily. Many of them we knew and had pre-existing relationships with. Many of them we sort of had on our radar and reached out to after we did the deal. And then, many of them sort of came through to us through reverse inquiry. It's been an extremely arduous task to kind of sift through the landscape and kind of figure out what makes sense and who's who. One should not underestimate the work and the effort. I think there's some perception, you raise the SPAC, boom, you call a few companies, you talk to the bankers, and the deal's done. That has not been our experience at all. It's been a ton of heavy lifting.
And Scott, to that point, I know you've just traveled during COVID to do either due diligence or have meetings. Just what's it been like for the private equity and SPAC world to do due diligence? It seems like nice to have cash. Valuations may have come down, but getting a deal executed, what's that like today for you?
Yeah, look, I mean, it's I think the COVID impact for us has been very much the inability to travel up until recently. And so much of this is based on relationships and spending time with people. And prior to COVID, we were constantly on the road. And then post COVID, it really sort of was limited to Zoom discussions. And only more recently, in the last month or two, have we sort of selectively traveled again. I would say that just generally, for me, kind of, and this is a little bit a tangent to your question, Mark, but it is worth mentioning in the mix of this discussion. For me, the greatest sort of tension in being a SPAC sponsor is the element of time. I mean, my whole background investing in emerging markets, the greatest discipline for me was patience and being able to wait and not being forced. It's also one of the reasons why we're so keen to raise permanent capital onto the balance sheet of Silver Spike. And so, I think what's been tricky about COVID is that, everything kind of stopped for a while, for a good 3 or 4 months. But when the world stopped, the SPAC clock didn't stop ticking. And so, one of the tensions that I think is really, not to be underestimated in the SPAC dynamic is, balancing the discipline of being patient and wanting to do a right deal on the right terms with the element of, every day that passes brings you another day closer to the clock running out. I think that just the sort of COVID backdrop has really brought that into the forefront for many folks that are out there on the hunt.
Yeah, if I can follow up with what Scott just said, I mean, that's precisely what cooled down my ambitions a few years ago when I looked at it, which was, the need for patience when you do any kind of deal in Africa versus the clock staring down at you every single day and you needing to get a deal done within, the next 18 months. And people realizing as that clock going down, your negotiating ability obviously goes down with it. So that was a cooling factor. Obviously, in my case, looking at what's going on in Africa, the dynamics have changed a little bit in that I feel, the access of African companies to the New York Stock Exchange and American capital markets has weakened a little bit because of COVID and because of what's going on in the markets and because of the slowdown in African economies. So to a certain extent, the dynamics have changed in that, and maybe naively I'm thinking this, but I'm thinking that there's more incoming calls that will be coming in for companies that had been looking at doing an IPO in the last, 12, 18 months that have now put that on the back burner because of what's going on in the markets. And now we'll see, a SPAC as a new route for them accessing the capital markets. So I agree with Scott, balancing the patience of emerging markets versus the time bomb of a SPAC is, one of the absolute decision-making issues that I'm thinking about as I'm determining whether or not I'm ready to launch the SPAC.
Two questions we just had come in. Tino Go had asked, it strikes me that the SPACs have a greater focus on target company growth than current or near-term cash flow, which is, how private equity firms tend to look at things. Is that a correct impression?
I think as a SPAC sponsor, for me, the main criteria is you want to do a good deal with a good target at a good price and valuation. I think today, clearly, what the market wants and whether that's a SPAC, a straightaway IPO, or any existing company that's out there trading publicly is growth. We're seeing that. There's a real premium to, the growth stories. I think as a thematic, some of the companies that have done particularly well through the SPAC vehicle have been these concept plays, like a Nikola or Virgin Galactic, or DraftKings or sort of the primary examples, right? Where, the market is giving them a tremendous amount of forbearance to, prove out their business model. But, that's really not that different from, what Tesla was 5 years ago. I think that, we've assessed a variety of opportunities, some of which are, more kind of like high growth in the future. Others are, sort of real kind of solid operating stories that have, real cash flow and real visibility today in terms of, their success and profitability. So I think it's, I think it's very much a function of the market backdrop. But, today, for sure, the stories that are doing well are, ones that have the promise of real kind of hyper growth.
Yeah, and if I can build on that, I mean, it's a very different vehicle than a private equity vehicle in that, basically you're taking a company public, right, through the acquisition. And as a result, the targets that you look at have to have the fundamentals of a company that's already publicly listed in New York, which is very different from what a private equity company would necessarily look at, because they're looking at businesses that are 2, 3, 4, 5 years away from, an exit through the capital markets. Wanted to tie in, my thinking on the SPAC with the presentation that Stephen Burke made earlier. And the reason why, I'm excited about the SPAC in Africa, if you remember the 4 pressures that he mentioned for deflation, demographics, scarcity of growth, technology, and globalization, I think those 4 dynamics are actually play very much in the favor of Africa. Demographics, don't need to spend any time on that. Obviously, the demographics are very attractive with the growth of youth and young adults. There is fundamental growth in many of the countries that are particularly coming out of, through demographics and technology. Those countries are so far behind that technology will actually allow to leapfrog rather than to the reduction of jobs that technology is bringing in the US. And obviously globalization and, what's going on with COVID. Hopefully, if the African countries manage themselves well with the free trade union that they've signed, that should bring more manufacturing into Africa and out of some of the Asian countries where it's been in the last 50 years. So, if you look at those four fundamentals that Stephen mentioned, I think that makes Africa actually an attractive place to look at right now.
Can I just point out, Joe, we have Jason Draho was our co-keynote from the last conference, and Jason, you're on it. You sent me this UBS research that you came out with on the 2nd. Do you want to just share a bit of highlights?
Sure. Good afternoon, everyone. I just joined about 10 minutes ago, so I missed probably the first hour of the conversation. But I sent this piece to Mark yesterday. It's a report we published on Friday because certainly for UBS, and this is in wealth management, there's a lot of focus on SPACs as opportunities because of how much how much is an issue this year. It's really an asset class that kind of appeals to some of our client base. So the report was meant to be initially kind of a bit of a primer, like a one-on-one on sort of what are SPACs, what's going on in the marketplace, what we kind of evolved over time. So it's also trying to give guidance to to our client base of how to think about SPACs as investments, so that it's positioned from their perspective and not from the sponsor perspective. And in the course of doing it, we pulled together some data looking at I did performance of at least of a sample of SPACs from the past few years. So it's a small sample, and I think it'd be dangerous to draw too strong conclusions on performance. But like as the chart there shows, like just how much has been issued this year. I think the numbers I saw as of 2 days ago is combined $43 billion in issuance this year in the U.S. with 110 SPACs. I think that the pipeline, when I talk to our colleagues, kind of when the capital markets division is, they say we could do like 2 or 3 a week. When we just the guidance that we gave is that if you're thinking about investing in SPACs, there's really kind of 2 decision nodes. Either you participate at the time of the IPO if you can get access, and that's it depends on how the distribution goes, or you think about waiting until the merger's announced and you make the decision then. And given the sort of the structure of a SPAC and has terms, whether it's the shares plus warrants, the promote that goes to the sponsor, some of the governance terms can be certainly more complicated than it is for a typical public company if it's a single share class structure and single one vote, one share. That it's not the easiest thing to invest in. And some of the discussion that I listened to with some of those of you who are thinking about or creating SPACs, the challenge of fund acquisition companies, from the investor perspective into a SPAC at the IPO, the question then becomes, how effective is the sponsor going to be at finding those companies? What comfort level do I have? So it just requires like a level of sophistication at the IPO stage to participate. But what we kind of suggest in the paper is that if you have the level of sophistication and you're comfortable with some complexity and some of the risks involved, that the terms of SPACs from the IPO data actually offer probably the best risk reward overall. Because of some of the downside protections with the redemption option. The stock price is usually very flat up until the merger announcement, and then it tends to rally on average. And so if you have that sort of upside optionality, especially with the warrants, the results can be pretty attractive, especially with some of the more kind of protections built in. But once the mergers are sort of announced, certainly from the completion date, the performance hasn't been very good, at least among the sample that we looked at, which is not surprising. I've done a lot of work on IPOs, a number of years ago. And if you look at, IPO performance, once you remove the first day price pop, over 1 year, 2 years, 3 years, 5 years, most IPOs on average don't do well, certainly relative to the market. There's a handful that do it spectacularly well, so we're always kind of looking for growth. But on average, they haven't done well. And if you think about the companies that might choose to go public via SPAC versus a traditional IPO, it's broadly saying kind of the similar sample size or sample pool. So you wouldn't expect huge deviations in performance, and that's kind of what the evidence suggests. So it's as an asset class, I think it's something that, again, for some of our investors, we think it's attractive if they can get into the IPO. And I know some of our advisors, what they've been doing is almost thinking of it as a quasi-PE type of investment where you allocate to a number of different SPACs, who focus on different areas, different strategies, in some way try and construct on your own a portfolio of ultimately kind of portfolio companies, similar to the way a PE fund would do. And they're putting that in sort of their kind of alternative sleeve, almost like kind of a liquid alts type of strategy. And that's kind of where we're seeing sort of traction. And I think, again, for those advisors who can kind of go down that path, and those clients who can go down that path, I think there's some good opportunities. I think for others who aren't as sophisticated, I think it's something that advice we gave is probably stay away until at least you understand the company that you're buying in terms of an operating company. That's basically the punchline of the paper.
Jason, we had a question from Stephen Burke, just kind of asking if you've thought about a target allocation to SPACs, like within that framework. Obviously, if you think it falls within that alternative bucket, but like how do you size that for folks?
So it depends on, well, let's think about the alternative sleeve. And so for a typical ultra high net worth client, our benchmark allocation will be about 30% for the whole alt bucket, which can certainly be higher or lower, but that's, let's take that as a target allocation. Depending on your risk profile, that kind of tilts more towards private equity as you kind of go up the risk profile. I would think of this would come out of something a little more of the hedge fund strategy, because certainly at the IPO date, in some way what you're doing is you're investing in a trading strategy, and it's similar to whether it's a venture event or relative value. So if that's the case, you think about it sort of coming out of maybe a hedge fund sleeve, which if the baseline allocation say is 10%, then we think, well, maybe you put like 3, 4, 5% maximum into a SPACs kind of portfolio, in part because it's still, as an asset class, if we want to define it as an asset class, still certainly emerging. It doesn't have quite the track record of hedge funds or private equity. It does seem like the industry is evolving a lot, and part of what we say in the paper is that the SPAC ecosystem has changed a lot. In terms of the investors that are coming into the marketplace to create SPACs, the amount of money they're raising, I think it opens up the opportunity set in terms of companies they're buying. Historically, at least the bigger company that goes public, generally speaking, the performance long-term has been better than really small companies. So all this suggests performance should get better over time. But right now, given the short history, I think you'd be a little more cautious in terms of how much you'd allocate. So, it doesn't make sense unless it's going to be at least a 2 or 3% allocation, but it probably wouldn't go above 5%.
Okay. It looks like Scott might be on the phone, but we did have a question from Arvind Rajan. Maybe Jason or somebody else who might be familiar could kind of speak to this, or maybe somebody else on the line could speak to this.
I'm good, Joe. Sorry about that.
Oh, cool. No sweat. No sweat. I saw you on there.
My daughter needing a new cell phone. I apologize.
Obviously, very serious matters. I understand. So, what sort of returns are the original fixed income ARB hedge funds looking for in the SPAC space? Are they new players or existing funds who kind of jumped into the SPAC asset class as it grew? What's the return profile they're looking for?
Yeah, I don't know that there's. I think there's a mix. There are definitely a core of hedge funds that have been playing in the SPAC space for some time, and I think increasingly there are more and more new players that are jumping in. With the plethora of deals that are getting done, again, I think there's one. I know of one of our investors who actually has like a SPAC fund. That's all. So a lot of the investors tend to be portfolio managers at like big multi-strat shops, right? But there is one investor in our SPAC who actually holds it in all. He holds it in the form of a fund that just has SPACs, and I think that fund, he was telling me, on average has generated like 7% average annual returns. And it's essentially a risk-free ARB again. So I think what happens is you have a portfolio. Some deals you end up redeeming and you don't really make anything. You make a treasury, a T-bill type of return. And then, some deals get announced and the stock goes to 13 or 14 or 15. And then, on average in that portfolio, at least in his case, it's been about a 7% return, which is, an amazing return in this interest rate environment relative to the risk that you're taking. So, I think that's an interesting data point. I don't know much beyond that, Joe, if there's, sort of a very specific target return. I've always felt, that the really kind of appealing feature is more, the upside optionality, with the downside protection structure that is afforded to the ARB investor.
Okay, cool. At this point, I don't have any other questions. I'm tapped out. I don't know if anybody else has a question they want to quickly ask. to either Jason, Scott, or Christoph. Feel free to kind of just chime in. Otherwise, we can wrap it up here. I think next week we're going to be doing a deep dive, as everybody knows, on, or at least we've said a little bit a while ago, on blockchain and cryptocurrency. When they're on the 13th after our 11 a.m. call, going to have 2 institutional investors provide their perspective on what's happening in blockchain and crypto and how to incorporate it into portfolios. That's going to be Marcos Varimas, who's a managing director at Evanston Capital Management, and then Andrew Chen, who is focused on alternative investments at Lockheed Martin's pension plan. They've both done a ton of work on crypto and blockchain. I think it'll be a really interesting conversation. And then following that, on the 14th and 15th, we're going to do a bit more of a family office and CIO kind of conference, and have different speakers and panelists and kind of covering different topics about what's going on in the world today. What are we seeing? What's exciting? So appreciate everyone's time. Scott, Jason, Christoph, thank you guys so much for all the content and color. Really appreciate it. And if people have further questions or want to connect, feel free to reach out.
Great. Thanks, Joe.
Thanks everyone.